From Embark headquarters in Dallas, Texas, this is Accounting Matters, an accounting podcast powered by Embark. Hi, hello, good afternoon. It's great to be with each of you. I'm Zach Smith, the newest member of the Accounting Matters podcast team and Embark's resident Tampa market president. I'm joined with my co-host, Adam Olsen, Embark's accounting advisory practice leader. Thanks for being here, Adam.
Of course.
On this week's episode, we'll be pivoting from fair value and diving deep into the world of business combinations, ASC 805. I'm joined today by Will Carroll, Valuation Practice Leader for Embark, and John Erickson, Valuation Service Line Leader for Embark. Gentlemen, thanks so much for joining us.
Thank you.
Thanks, Zach.
Good to have some new faces.
Good to have some new faces indeed. Well, so Adam, thanks so much for making some time for us today. I know that we spoke a lot about fair value last week, discussing the deal life cycle and what that would look like. Tell me a little bit about how business combinations, specifically 805, would fall into that deal life cycle world, and why is this important to businesses that potentially are growing, expanding, and some of the accounting implications that we need to be thinking about.
Yeah, we've talked about business combinations in prior episodes. I think what's going to be unique about today's conversation is the fact that we'll talk about the elements of where fair value measurements come into play when it relates to business combinations. So obviously having our valuation folks in house to help us kind of navigate that conversation will be useful. But really a lot of times what drives the need to do kind of the purchase accounting under ASC 805 is like what you said, where businesses are looking to acquire other businesses or groups of assets for a variety of reasons. And it could be, strategic investments to grow in a particular geographical area or market, maybe expand products or services, or maybe they just want to build the size of their business overall. There can be a number of reasons why they may enter into that type of transaction. And, the first thing they have to do when they enter into any of those transactions is really, at least from a US GAAP perspective, is figure out what subset of accounting they should be applying. And so a lot of times you'll hear people refer to, we've got to figure out whether or not we acquired a business or whether or not we acquired, a set of assets, namely called an asset acquisition. So the way that typically works, just as a refresher, and I know we've done past episode on this specifically too, so I'll just point listeners to that episode if they want a little bit more detail, but just at a high level, kind of how that works is there's essentially kind of a two-step process that you go through to figure out whether or not the transaction you've entered into is a business combination or an asset acquisition. And so the first step is what's known as this screen test. And so the screen test more or less is looking at whether or not, when you're looking at kind of your set of assets that you acquired, whether any, substantially all of the fair value is concentrated in one specific asset or a group of similar assets. If you have that, or you trip that kind of threshold, it's not technically a threshold, but theoretically a threshold, you would fall into having an asset acquisition. It would default to that. If you don't, then you kind of move into step 2 of the analysis, which is evaluating whether or not the transaction meets the definition of a business. And so the definition of a business, there's a couple things you got to think about. The first thing is whether or not you've got outputs present in the transaction. So generally, if a business you acquire is producing revenues are considered outputs. So you would follow one set of guidance where you just look at whether there were inputs in the transaction as well as the substantive process. On the other hand, if you were to maybe acquire like an early stage entity or something that's pre-revenue, in order for that transaction to qualify as a business, you would have to acquire an organized workforce as well as inputs that could essentially develop or create outputs. So you go through that whole analysis, you either end up with a business combination, which would be subject to ASC 805, or on the flip side, you would end up with an asset acquisition, which goes into the subsection guidance in 805-50.
So great point, Adam. So after you've done this screen test and you've determined whether or not it's asset versus business, what happens next? Where do we want to head?
Maybe just backing up a sec is, I think the critical thing to think about is you don't want to shortcut that assessment of business combination versus asset acquisition, because the accounting models diverge quite a bit at that point. So just to maybe hit the highlights on some of the key differences, and obviously this will play a lot into if you do, engage a valuation specialist to help you out, kind of how they're assessing the underlying accounting for you guys with relations to the fair values. But a business combination, more or less is going to require everything to be measured at fair value. There's limited exceptions for certain things, but almost everything is measured at fair value on the acquisition date. A key difference there between a business combination and an asset acquisition is that an asset acquisition uses what's known as a cost accumulation model. So it's more or less based on the relative fair values of the assets that are acquired. So it's a little bit different approach. Business combinations, they'll result in creation of goodwill or a bargain purchase in most cases, whereas an asset acquisition does not. So, those are just some of like the maybe higher level differences between the two models. There's a bunch of other things, and we've also done a podcast on differences between business combinations and asset acquisitions. So another plug for check that episode out if you want to understand maybe some more of the minute differences that exist between the guidance. But I think the big thing here is just like how you're measuring what was acquired is significantly different between a business combination and an asset acquisition.
Okay, so that's helpful. So now that we've got ourselves a business combination, John, why don't you tell a little bit about where your team comes into play?
Yeah, no, thanks, Zach. So in the business combination, first you have to determine your consideration paid and then what assets you acquired to go along with it. Consideration can be tricky with different terms and negotiations between different parties, particularly where you have earnouts or stock compensation or key employees that you want to incentivize to come along with that business. You have to go through other determinations, whether it's consideration for a business or whether it's stock compensation or other things. So the simplest would be cash for assets. It's easy to value cash. A lot of companies use stock to acquire other businesses. They assume debt, which would also need to be fair valued. And then when you get into different earnouts, you get into more complicated valuation techniques around Monte Carlo simulations or option pricing models, which often give a lot of surprises to clients. So a lot of the earnouts are negotiated in commercial terms, but when it comes to accounting, there's a pretty strict framework of how you value those. And so that's where we get a lot of surprises and where we can be very helpful.
Do you see a lot of companies trying to do any of that work themselves? I feel like a lot of clients are always looking to take a shortcut, and maybe ultimately they attempt it and then they'll come to you guys kind of like, last day of the audit or whatever to like, hey, we need help here. We didn't do this right, or this is way more complex than we thought. Is that something that you would recommend companies just avoid taking on themselves, or like, what would be the deciding factor to maybe involve someone like yourself in the equation?
So these are accounting valuations, and there's a lot of work that goes into getting a transaction done commercially. So there's a lot of incentives to structure these earnouts and different things the way they are, but accounting is usually not the primary consideration.
Right.
So a lot of clients anchor on different numbers, what the max payout is or what they expect via their budget or other things. And I think a lot of times there's just a surprise that there's a very detailed accounting framework that their auditor is going to want to see. And if that's late in the process, it's just a lot harder to catch up when the deal's not fresh in your mind. So you do see it. Oftentimes there's a material difference between what's expected and what actually happens, particularly where some of the earnouts go to former employees of the business. And whether that's stock compensation or consideration can be a very significant difference.
So I think it's important for when the transaction happens, start a conversation with your auditor and talk about what you know about the purchase price allocation, business combo, valuation process, and socialize it with them. They've been through it many, many times. And they can give you advice and point you in the right direction, or also point you to people who can help you.
Yeah, so Will, that's great segue into the allocation step of this business combination. Talk to me a little bit about what that would look like from market participation perspective, PP&E, real estate, intangible assets, any of those things, and some of the considerations that we need to think about around those.
So after you've determined the consideration that's available for the allocation amongst the assets, the next step is to identify what assets and liabilities exist in the transaction. Liabilities could be an asset retirement obligation, a supply contract, or a lease obligation that is out of the money somehow, where it's unfavorable. Those are probably the most common liabilities that we see. Some kind of payable that needs to be fair valued. On the asset side, it's the assets list. The list of possible assets is pretty long. We start off with what's the primary driver of the transaction? What asset is attractive that is going to allow you to achieve the forecasted cash flows that you expect that this business can deliver to you? And I'll start off with some of the intangible assets that could exist. There might be a customer contract that you're stepping into the shoes of and are going to enjoy that. You didn't sign up the contract, but you're enjoying it on a go-forward basis. Or there could be customer lists. Those customers drive revenue or have a relationship with them where you can rely on revenue on a go-forward basis. There might be intellectual property. Intellectual property could come in the form of patents or proprietary formulas for some type of a device. Could be know-how or some other code or patent that exists. All of those could be reasons that differentiate your business or the target business from others and drive revenue.
And I think you raised actually a good point here when you're speaking about these different intangibles, is that a lot of times what you guys are valuing is something that the acquiree may not even have recognized on their books, right? Because a lot of these different intangibles were internally developed, so obviously there's no recognition for them on the balance sheet. But as an acquirer of that business, these are things you have to think through, as like, what are some of these other assets that maybe weren't recognized previously that we do have to assign value and recognize now? Because you guys aren't necessarily, from a valuation side, helping fair value every asset that they acquired, right? There's specific assets you guys are probably being brought into the fold to help clients, figure out what they are and then how much value we should assign to those assets.
Yeah, I think intangible assets, as you said, is one where you're introducing a new item on the balance sheet,
right?
Oftentimes. So a customer list, if a business could, or usually organically grows those lists, but until they're acquired, there's no asset or trademark or other item on their balance sheet. And the methods to value these are pretty esoteric. So how do you value a trade name or the existence of customers? Generally, for an intangible asset, the most significant asset, what we see most often is that customers are the most significant intangible asset for most of the businesses that we see. And we use what we call multi-period excess earnings method generally to value those. And so this puts you into this sort of theoretical world of if I had to pay rent to all the assets that support this business, how much profit's left over, and that excess profit is what's attributable to this customer list. So you will find revenue associated with those customers, attrition rates associated with losing customers over time. Ultimately, you'll look at contributory asset charges. So I'll pay rent for the tangible property. I'll pay rent for the trade name. I'll pay rent for a trademark or technology. And then after everything's left over, I discount that at an appropriate discount rate. And that's how you get a customer relationship. So I think, or a value via the MPEM, which is often used for customers. And it's a very strange world because I think in a commercial setting, people don't usually value a business under the theoretical rent that they would pay for the different components. But when it comes time to account for it, it's different. And so you ultimately need to put that on your balance sheet and in your income statement and go through some of these methods that a lot of times it's just helpful to work with somebody who's done it a lot of times and gone through the audit process on that.
So what kind of information so if you're assisting a client with valuing, let's say their intangible assets, like what information are you requesting of them that they need to be thinking through to prepare or have ready to help assist the valuation aspect? You know what I mean?
Yeah, I would say the most frequently used piece of data to value intangible assets is a forecast of the future cash flows. It's used on the list of possible intangibles. It's used in almost every single intangible asset analysis. There's so it's used again and again and again. The different methodologies are different between valuing each asset. The MPIM for customers, or what the primary intangible is, leverages the forecast in a DCF. A relief from royalties might be used to value a trademark or trade name. It uses a form of a discounted cash flow to do that. A with or without method could be used to value an intangible asset, maybe a license or a permit to conduct business. That also uses leverages the discounted cash flow. So that forecast is, and I tell companies when they go through an 805 valuation, the forecast is important, and it's important because we use it over and over and over. And that's also in the forecast what, in a prior episode when you and Matt were talking about the market participant premise, oftentimes a forecast that you receive from a company captures synergies that might be business and entity specific. And we need to make sure that any synergies market participants would also enjoy, and they're not entity specific. So kind of a double importance on the forecast of future cash flows, because we use it often, and it's got to meet the boundaries set forth in the market participant framework.
Well, it's just interesting thinking about, from a fair value construct, the level 1, 2, and three inputs. So when you get into things like intangible assets, they're almost always a level 3 input. So there's not an active market for trade names or something else that you can go and say, well, this other trade name went for this, so mine must be worth X. So intangibles are some of the more esoteric valuation methods that are generally level 3 inputs. But there's other assets that are usually in a purchase price allocation that are different, like PP&E, which we often use a cost approach or even a market approach.
When we talk about the hard assets, I think it could be land or building, any kind of leasehold improvements for office space or otherwise. There's also revenue generating equipment like machinery and factory equipment, support equipment like office furniture, office equipment, computers, IT stuff, and then mobile equipment, which has a visible secondary market in order to go look for level 2 inputs, and stuff like passenger vehicles. Forklifts is one that we often see in quite a few industries. In each of those assets and intangibles or property, plant, and equipment hard assets requires a different set of data in order to analyze. And the data available really drives the analysis that's performed in order to fair value those assets.
And so there's a lot of different kinds of assets, obviously, that we've talked about, between PP&E and land and items that are under the cost approach, as well as intangible assets. And ultimately, once you're done with all these different kinds of assets, you have to put them all together to make sense and to make sure that allocation reconciles back to the overall consideration paid, the rates of return that are implied from the transaction, and the rates of return for that asset class. So something like cash, if it was involved in the transaction, would have a much lower rate of return than an intangible asset. A tractor trailer or something like that would also be lower than a trademark, or ultimately, if there's a residual where we valued all these assets and there's still consideration that you can't find an asset for, then you would have goodwill, which will generally have the highest rate of return would be on goodwill or some kind of going concern value that you're acquiring that isn't attributable to an identifiable tangible or intangible asset. So one of the ways we do that is via a WARA reconciliation. So what's the return on each of these asset classes, the IRR, and then market participant cost of capital. So the rate of return you get should be commensurate with the risk of those cash flows. And oftentimes you'll have a rate of return higher than the cost of capital, but usually it's associated with some kind of growth factor or a synergy that's included in that forecast. And so once you're done with this, there's a lot of implications for a purchase price allocation, particularly in a business combination is usually not routine and is often material. And so a lot of an organization's effort goes into getting a transaction done. But if you're not conscious of the accounting implications, how that's measured for all the stakeholders can be can lead to surprises if you're not careful. So tangible assets from a book perspective will usually be depreciated on some kind of straight line method associated with their remaining useful life. Intangible assets can vary quite a bit. And so it's hard to think, how long does a customer list last? What kind of amortization period should I have? Same thing with a trademark. Sometimes we see an indefinite live trademark, or would you put a life on it for something less than that? There's a lot of factors that go into it, and really experience with what industry norms are, what the forecast looks like, and other things. So,
Do you guys help direct clients towards useful lives if they're unsure? Like, you give them parameters, or if they are like leaning towards an indefinite life on a particular type of asset, is that something that you challenge, or is that part of the process, or do you really rely on them and their like assertion that
I'd
they
say
really think
it's a process, and there's multiple inputs into that process. I think there's what the data for that analysis shows us on for that transaction. There's also the, call it, history of us helping others in similar situations and what they have done for the remaining life of those assets. The auditor has a seat at the table as well, and they have also a history in those circumstances. And so you smash all those together, and it's a collaborative process.
Yeah. There's not a right or wrong answer on
right. It's an estimate, right? Like
right.
coming up with that useful life or the indefinite life.
But I do think it's helpful in the process, just having a lot of reps on what you see, especially in a particular industry. We also benchmark our results against other financial statements and really have a comprehensive process, so that oftentimes we provide a range of estimates and just try to get a number that's reasonable. But the implications, with goodwill or an indefinite lived intangible, you wouldn't hit the income statement going forward, but you would remeasure for impairment under a more restrictive standard.
Right.
And so it does have a purchase price allocation, does have direct implications to the income statement going forward, both just in preparation of the financial statements, but also when you think about just commercially for the stakeholders who want to do another acquisition. When they go look at their P&L, how is it reflected, and how do I measure your ability to do transactions? Ultimately, a lot goes into the purchase price allocation.
Right.
So this has been really helpful. Adam, anything else that we need to be thinking about as we finish the valuation and what that's going to look like from an accounting perspective?
Yeah, I think it's important to recognize that the valuation work that's done, either in-house or through the use of a specialist, is really it's a critical input, but it ultimately goes into the company determining what is their opening balance sheet. So we mentioned that term, purchase price allocation, which is more or less essentially establishing that opening balance sheet. Once that's ready to roll, companies have to figure out a way how they ultimately book that. So they got to record that purchase price allocation into their general ledger, thinking about the disclosures around the acquisition that will result as well, pulling those together. And ultimately, this all kind of gets buttoned up into usually a technical memo that, you either bring in outside help to assist with that from an accounting advisory perspective, or, acquisitions are pretty routine in your organization. You may have the expertise in-house to pull that together. But just kind of keeping in mind that, you'll get a valuation report, but usually that's not where the buck stops. There's usually additional work that has to be layered in on top of that. So keeping that in mind as you're working to complete your acquisition.
Well, perfect. Well, gentlemen, I appreciate everybody taking some time out of their day to be here and discuss this topic. Thank you so much for joining us on Embark's Accounting Matters podcast, and we'll see you next time.